So how can you pay your 25 or 30-year mortgage in as short as 5 to 7 years? Coming right up on MoneySenseMedia. Hey everyone, this is Miles from MoneySenseMedia, and on this channel we talk about tips and tricks for your financial health. Before talking about today's topic, I just want to take a few seconds and thank you for tuning in. There's a lot of choice out there on YouTube and you're choosing to subscribe and to spend some time with me, and I really appreciate it. Speaking of subscribing, if you haven't already done so, please click on the bell notification in order to get notified when I post a video, smashing the like button and sharing the video with a friend. All right, let's get into it. So today we're talking about an accelerated method to pay down your mortgage. Now I want to put a bit of a disclaimer out there. This method is not for everyone. Please stay until the end of the video where I talk about the 6 things that you need to evaluate to see if this is a method for you. So there are really 3 reasons why you would want to pay your mortgage faster. The first is you want to stop paying interest to the bank. Over the regular course of your mortgage, you're going to pay tens of thousands and even hundreds of thousands in interest to the bank. So if you're able to reduce the amount of time you have your mortgage, then that's money that you don't have to pay. The second reason is because you're actually interested in saving and investing. Think about it. What a lot of people do is that if they're able to pay their mortgage over 5 years instead of 25 years, that monthly payment that they had committed to for 25 years, they're going to turn around and increase their savings, their giving, or even their investing. And that's a very powerful tool to increase your wealth. The third reason is because of time. Now imagine this for a second. Instead of having a 25-year commitment, you're able to fulfill that commitment in 5 years or 7 years. In my situation, I have a 2-year-old and a 4-year-old, and I love the idea of having more time to spend with them. And so there's a big incentive for me to find ways, creative ways, to accelerate the payment off my mortgage. So let's talk about the core concept here for just a second. When you purchase a home, you have a mortgage traditionally, and you make monthly payments. A portion of your payments go into interest, and the other portion goes into principal. When you start paying your monthly payments for your mortgage, a big chunk of it goes into your interest and only a small portion goes into your principal. The way to accelerate your payments is by leveraging what is called an investment line of credit, or a HELOC, a home equity line of credit. And the way that works is actually pretty simple. Every time you make a monthly payment, that portion of principal that you've paid on your house actually is connected to the HELOC and it becomes available for you to borrow. And so you borrow that amount and you invest it. Simple as that. So wait a second. If you're actually making a mortgage payment with one hand, but borrowing on the other hand, aren't you owing the exact same amount of money at the end of it? Absolutely. You're reducing your mortgage over time and increasing your investment line of credit over time. So why the heck would you do anything like that? So there are a few reasons why you want to consider this approach. Number 1, it actually accelerates significantly the time in which you can actually pay your house down. Think about it for a moment. If you're investing and you're getting 5 to 6% return on that investment on a monthly or quarterly basis, and you take those earnings and you put them back into a principal payment on your home and reborrow all the time, you're actually adding velocity to your money and you pay your mortgage down significantly faster than the traditional 25 to 35 years. The second reason you want to do this is because the interest that you're paying on your investment line of credit is tax deductible, whereas the interest you're paying on your home is not. Now this only applies to my Canadian viewers because in the US you can actually deduct the interest you're paying on your mortgage, even if it's for a principal residence. You can't do that in Canada. Number 3, you're doing this and you're actually building an investment portfolio at the same time as you're reducing or eliminating your mortgage. So this is very, very, very important. Traditionally, when you purchase a home and all you do is pay it off over 25 to 30 years, after that period of time, you have a home and no debt. With this method, after 5, 7, or even 10 years, you have a home, you have debt, and you have enough investments to clear this debt or even clear this debt and still have money in the bank. That is the power of this tool. The last reason you want to consider this approach is because an investment line of credit has conditions and terms that are significantly more advantageous than a traditional mortgage. With a traditional mortgage, there are very strict criteria and rules around you making prepayments. It can only be X percentage of the amount, only once or twice a year, and so on and so forth. And if you pay too much, if you have money and you want to pay more down on your mortgage, they're actually going to charge you some penalties for wanting to give them their money faster, which is completely ludicrous. But again, it makes sense because the way the banks make money is with you holding a mortgage for 25 to 30 years. When you have an investment line of credit or a HELOC, a home equity line of credit, all you really need to worry about is the interest that you're paying on the line of credit on a monthly basis. You can prepay and repay that puppy as slowly or as quickly as you want. And that is a significant advantage when you're looking at becoming debt-free and financially free. So I want to talk for a second about the disadvantages of this method, because a lot of people talk about how great it is to pay your home in 5 to 7 years, but they're not putting any emphasis on, what it takes to actually pull this off. And there are a couple of drawbacks that you have to be mindful of. The first is that it takes a bit of time to set this up. You need the right accounts, the right processes in order to build it. And if you're not financially disciplined, it can get a little messy and a little bit crazy. The second real risk is that there is a chance that the return on your investment portfolio is actually weaker or lower than your mortgage interest rate. So I'll give you an example. Let's say you had a mortgage with a 2% interest rate, and you were using this technique in investing in the stock market or investing in some other kind of financial products, and the return on those other products was 1.5%. Well, that's not good. You're actually losing because you're investing at a lower rate of return than your mortgage. So from that perspective, you'd be losing. The other element that's a bit of a disadvantage is the interest that you're actually saving and that you can declare on your income tax. Well, you can't deduct the entire amount of interest. The amount of interest you're going to be able to deduce is going to be connected to your income tax bracket, or your tax rate as a whole, I should say. And so let's say you're paying $100 worth of interest on that HELOC this year. You're not going to be able to claim 100% of that amount. You would only be able to claim $100 times whatever tax bracket you're in. Okay, so let's talk about the 6 things that you need to consider to see if this is the right technique for you. You'll remember that I said that this approach is not for everyone. Number 1, you need to have at least 15 years or more left on your mortgage. If you have anything less, then this technique might not be for you. Number 2, you need to have at least 20% of equity in the home for the lender or the banks to actually consider giving you a home equity line of credit. If you have anything below that, the banks are going to walk away and say it's just too risky for them. So if you put 5% or 10% down on your home and the value of your home hasn't really changed since the moment you've purchased it, chances are you're not going to be eligible to obtain a home equity line of credit. Number 3, and if you know my channel, you know I like to harp on this, you need an emergency fund. When you're going into this type of application or technique to accelerate the payments of your home, you want to have a bit of a buffer. And so I always advocate having 3 to 6 months of monthly expenses saved somewhere under your mattress, in a checking account, or a very liquid asset just in case of a rainy day. Number 4, you should not have any consumer debt if you're going to get into this type of a technique, which means what? No credit card debt, no car loan debt, no furniture debt, nothing, no debt. And the reason I say that is very simple. When you're getting into a line of credit, it is an extra form of debt. So the last thing you want to have is be distracted with your mortgage, your line of credit, and a bunch of other credit cards and credit lines that you have to take care of. Number 5, you need a team to pull this off. In my experience, you need a team of 3. You need one accountant that's going to help you with your taxes. You want one mortgage broker who's going to put you in the right mortgage facility and the right lending facility. And you need an investment advisor. This is not the situation where you're going to go out and buy some Bitcoin and hope that it's going to go up over a year or over a month. You need an investment professional to guide you through this process. So the team is going to make the difference. Number 6, you need to want this. This is not something that happens by fluke. People that pay their houses down in 5 years, in 7 years, or 10 years, it just doesn't happen because they just won the lottery. It happens because they're intentional about what they want to do and how they want to get that time back in their lives. So I hope this video was helpful to you and it inspired you to look at ways for you to pay your mortgage down significantly faster. On my next video, what I'll do is I'll do a deep dive with a live example so that we could use some numbers and you could see exactly how this technique works. Thanks for tuning in, and I'll catch you on the next one.